Just over a year ago, Wall Street analysts, technological historians, and financial television's loudest voices were actively preparing to write the final, devastating obituary for the undisputed king of American semiconductors. By late 2024, Intel Corporation's valuation had collapsed to a terrifying low of roughly $17 per share. Think about what that means. This is the absolute pioneer of Silicon Valley. This is the company whose hardware formed the foundational bedrock of the modern digital age. This is the corporation that literally put the silicon in Silicon Valley. Yet, to the entire financial world, they appeared fundamentally, perhaps permanently, broken. The corporation was bleeding critical cash reserves at an alarming, unsustainable rate. It was continuously surrendering its once impenetrable server market share to highly agile, aggressive competitors like AMD. Most embarrassingly of all, Intel had seemingly missed the explosive trillion-dollar first wave of the artificial intelligence boom. It was a massive technological paradigm shift, overwhelmingly dominated by their bitter rival, Nvidia. The market capitalization of this historic American behemoth had sunk well below the psychological $100 billion threshold. The narrative across the tech ecosystem was cemented into stone. Intel was a legacy relic, a dinosaur paralyzed by its own staggering scale, trapped in desperate cost-cutting mode, and wholly unequipped to navigate the brutal physics of the modern semiconductor landscape. But the reality of global financial markets today presents a jarring, almost violent contradiction to those grim forecasts. Here in April 2026, Intel's stock is hovering right around the $50 mark, specifically trading at $50.35. This massive 145% rebound from its absolute nadir pushed the company's market capitalization well over the $240 billion threshold. It is a corporate turnaround that almost entirely defies economic logic. So, the multi-billion-dollar question is this: how does a corporate behemoth, trapped in a terminal downward spiral, dragging tens of thousands of employees and billions in sunk costs, pull off one of the most aggressive high-stakes resurrections in modern economic history? The resurrection of Intel was not luck. It was engineered. It rests upon three distinct pillars: a ruthless new executive regime, a foundational shift in the laws of semiconductor physics, and an absolute masterclass in capital restructuring. The rebound had to start where all true corporate turnarounds start, at the very top. For years, Intel had a severe culture problem. It wasn't a lack of smart engineers, it was a surplus of bureaucracy. In March 2025, Intel executed a brutal but entirely necessary leadership change, bringing in semiconductor industry veteran Lip-Bu Tan as chief executive officer. He stepped in following the highly publicized, chaotic departure of former CEO Pat Gelsinger. You have to understand who Lip-Bu Tan is. Tan was not a traditional corporate caretaker brought in to manage a gentle decline. He was not a cheerleader hired to artificially pump the stock. He arrived with a reputation forged in the fire of aggressive corporate restructuring. What made Tan the perfect weapon for Intel was his history with the company. He already knew exactly where the bodies were buried. Having previously served on Intel's board of directors, a position he abruptly exited in August 2024, citing deep frustrations with a bloated workforce and risk-averse culture, he had already seen the internal mechanics of the machine. He recognized exactly what was suffocating the chipmaker. Upon taking command in March 2025, Tan immediately executed a ruthless, systematic turnaround strategy. He identified that Intel's internal management structure was dangerously overgrown. In leaked internal memos, he noted that brilliant engineering teams were buried 8 or more layers deep beneath the executive suite. It was a fatal symptom of corporate bloat, where the logistics of managing the workforce had entirely overtaken producing the actual product. Under Lip-Bu Tan, Intel dismantled this philosophy with extreme prejudice. To streamline engineering and drastically reduce operating expenses, Intel announced the largest layoff in its corporate history. a 15% global workforce reduction equating to approximately 24,000 jobs eliminated. By the end of 2025, the company's total headcount was aggressively capped at roughly 75,000 employees. The accompanying financial mandate was equally unforgiving. Overall operating expenses were strictly targeted to drop to $17 billion in 2025, a massive $500 million cut, followed by a further reduction to $16 billion in 2026. The toll of this immense restructuring was immediately visible. In the first quarter of 2025 alone, amidst flat year-over-year revenues of $12.7 billion, the company booked $156 million purely in restructuring charges. Traditional sprawling corporate branches essentially evaporated. TAN took that suffocating 8-tier hierarchy and compressed it into a highly streamlined, fast-moving 4-tier structure, functionally eliminating entire strata of middle management. This era of strict austerity extended far beyond human resources. It fundamentally reshaped Intel's global physical footprint. For decades, Intel operated on a legacy "build it and they will come" mindset, pouring tens of billions into sprawling fabrication plants well before demand for the silicon was actually secured. TAN pragmatically abandoned this strategy. In semiconductor manufacturing, you cannot afford sentimentality. He unilaterally cancelled massive ego-driven megaprojects across Europe. Most notably, he completely halted construction of a planned €10 billion fabrication plant in Germany and a highly anticipated assembly facility in Poland. Assembly logistics were aggressively shifted to lower-cost, established geographies like Vietnam and Malaysia, where supply chain efficiencies could be immediately maximized. Meanwhile, the massive existing site in Costa Rica was entirely converted to focus solely on high-level research and development. To permanently revive a culture of speed, precision, and lean execution, TAN enforced a strict 4-day-a-week in-office mandate for all engineers. Furthermore, to ensure absolute quality control and prevent disastrous tape-out delays, TAN instituted an uncompromising policy. Prior to being sent to fabrication plants, every single major CPU design now required the personal, direct review and approval of the CEO himself. Intel was no longer a sprawling, comfortable bureaucracy. It was a war room. This ruthless operational efficiency caught the attention of players far larger than Wall Street hedge funds. It caught the attention of monumental, nation-state-level capital. Here is the geopolitical reality of the 2020s. Semiconductors are no longer just commercial products. They are the fundamental military and economic battleground of the 21st century. Advanced silicon powers, modern missile guidance systems, national power grids, and the artificial intelligence networks dictating global economic supremacy. Right now, a massive percentage of the world's most advanced chips are made on a single island, Taiwan. For the United States government, realizing that Intel was teetering on the edge of the abyss was a matter of dire, code-red national security. If Intel fell, America's domestic capability to manufacture advanced silicon fell with it, leaving the US entirely dependent on foreign supply chains in a highly contested geopolitical zone. Recognizing that a financially stable Intel was a matter of literal national survival, the United States government intervened directly in August 2025 to permanently secure the American supply chain. In a move fundamentally altering the relationship between the government and private enterprise, the US government invested $8.9 billion to acquire a 9.9% passive equity stake in Intel, purchasing the stock at exactly $20.47 per share. This massive capital infusion wasn't entirely new money printed by the Treasury. It was an absolute masterclass in creative financial engineering, achieved by converting $5.7 billion in previously awarded CHIPS Act grants, alongside $3.2 billion from the Department of Defense's Secure Enclave program, into direct stock ownership. This unprecedented financial maneuver made the United States government the company's largest single shareholder. It was essentially the creation of a taxpayer-funded Silicon Shield. While the government purposely received no active governance rights, legally maintaining Intel's operational independence, the deal radically changed the company's financial liabilities. Crucially, it completely eliminated highly restrictive clawback and profit-sharing provisions attached to the original federal grants, ensuring an absolute permanency of capital for Intel's ongoing domestic expansion. But the US government didn't just write a check, they installed a failsafe. The agreement uniquely included a 5-year warrant allowing the government to purchase an additional 5% of shares at exactly $20 each. The genius part: this warrant is exercisable only if Intel's ownership of its foundational foundry business ever falls below 51%. This acts as a structural poison pill. It permanently prevents Intel from entirely spinning off or selling its most critical domestic manufacturing assets to foreign entities. The US government essentially told the world, "We will save this company, but these factories belong to America." The market read the geopolitical tea leaves instantly. Shortly after this massive governmental endorsement, Japanese investment conglomerate SoftBank injected an additional $2 billion into the company, paying $23 per share. It sent a glaring, undeniable signal of deep institutional confidence in the new leadership's trajectory. But let's be real. A new CEO, a streamlined workforce, and billions in fresh government capital cannot save a semiconductor company if the chips themselves are fundamentally flawed. At its core, beneath all the financial engineering, Intel is a manufacturer. Its entire corporate survival depended entirely on the successful execution of a next-generation manufacturing node codenamed Intel 18A. For years, observers and highly frustrated clients watched the company stumble through the 10-nanometer and 7-nanometer eras. Those generations were characterized by cascading delays, terrible wafer yields, and technical missteps allowing rival foundries, most notably TSMC, to seize the undisputed technological crown. The 18A node had to be absolutely flawless. There was quite literally no margin for error left on the balance sheet. At the Consumer Electronics Show in January 2026, Intel finally proved to the global market they could deliver. They officially unveiled the Core Ultra Series 3 processors, heavily anticipated under the development codename Panther Lake. This launch wasn't just a product update. It represented a monumental technical milestone in the history of silicon fabrication. It was the first major consumer compute platform built entirely on the 18A process, instantly making it the most advanced semiconductor node ever successfully developed and manufactured at scale on United States soil. To understand why 18A was the ultimate savior of Intel, you have to examine the staggering quantum physics behind the node. It represents the most significant, foundational leap in Intel's transistor innovation since they introduced the FinFET architecture back in 2011. The 18A architecture relies primarily on two groundbreaking technologies, RibbonFET and PowerVia. By completely surrounding the transistor's electrical channel to stop power leakage and moving the entire power delivery network to the backside of the silicon die to eliminate microscopic traffic jams, Intel achieved an absolute marvel of spatial efficiency. The combination of RibbonFET and PowerVia allows the 18A process to deliver up to 15% better performance per watt, and a staggering 30% improvement in overall chip density compared to the previous Intel 3 node. The final result is an incredibly impressive transistor density of roughly 238 million transistors per square millimeter. But specifications on a sterile engineering document only matter when proven in the real world of consumer hardware. The Panther Lake flagship processor, officially designated the Core Ultra X 9388H, unequivocally proved the architecture's viability. Independent testing confirmed the raw power of the 18A node. It traded direct blows with Apple's formidable M5 Pro and demonstrated such immense integrated graphics capability that it entirely eliminated the need for a separate power-hungry GPU in premium laptops. Most astonishingly, thanks to the physical efficiency of the 18A node's backside power delivery, The processor demonstrated completely unprecedented battery life. Tested inside laptop chassis, it was capable of up to 27.1 hours of continuous 1080p video streaming, pulling a maximum peak gaming power draw of only 108 watts. Imagine charging your laptop on Monday morning and not needing a wall outlet until Wednesday afternoon. By successfully launching the 18A node to the consumer market exactly on schedule, boasting massive leaps in AI processing capability alongside record-breaking battery life, Intel proved to deeply skeptical investors and prospective future foundry customers that their manufacturing arm was no longer a liability. It was, once again, a world-class asset. With core manufacturing technology finally yielding highly competitive results, corporate leadership felt emboldened to execute its biggest, most aggressive financial maneuver in years. To fully grasp the significance of this capital restructuring, you have to look back to the desperate financial straits of mid-2024. At that time, Intel was effectively starved for capital necessary to fund massive, cash-incinerating global expansion plans under the previous administration's IDM 2.0 strategy. Building fabs is the most expensive manufacturing undertaking in human history. Desperate for liquidity, Intel engaged in a strategic co-investment program. When the corporation was functionally broke, they made the agonizing decision to sell a 49% equity stake in their highly advanced Fab 34 facility in Leixlip, Ireland. The buyer was the massive private equity firm Apollo Global Management. In exchange for a desperately needed $11.2 billion capital injection, Intel agreed to a highly restrictive structure. They were legally required to purchase wafers produced by this joint venture on a strictly cost-plus-margin basis. Furthermore, Intel committed to minimum purchase volumes that structurally guaranteed heavily profitable revenue streams for the private equity venture. From a purely logistical standpoint, it was essentially the corporate equivalent of taking out a massive, high-interest payday loan using your own multi-billion-dollar European factory as collateral. Imagine selling your kitchen to a bank and paying a premium markup every single time you cook a meal. But the landscape completely changed in April of 2026. A newly cash-confident, operationally streamlined Intel struck a definitive agreement to buy that 49% equity stake completely back for $14.2 billion. This repurchase sent an undeniable shockwave through the global financial markets. It was the ultimate corporate flex. It was Intel loudly declaring to Wall Street, "The emergency is over. We are taking our factories back." While Apollo Global Management walked away with a highly lucrative $3 billion premium on their original 2024 investment, Intel fundamentally and permanently solidified control over their own global supply chain. So, the logistical reality is that Intel fought its way back from the brink of death to $50 a share. But what happens next? The ultimate corporate goal for 2026 and the decade beyond isn't simply selling branded Core Ultra processors to Dell or HP. The ambition is vastly larger. Intel wants to be the primary foundry for the entire world. They want the world's most valuable technology companies, Apple, Qualcomm, and Nvidia, to pay Intel to manufacture their proprietary chips, directly and aggressively challenging TSMC's virtual stranglehold on the global semiconductor supply chain. To achieve this incredibly difficult feat, the company must convince its most brutal, historically bitter competitors to become its largest, most reliant clients. The foundation for this audacious geopolitical shift was laid quietly in September 2025 via a historic, industry-shaking strategic partnership with the reigning undisputed king of artificial intelligence, Nvidia. The physical and financial scale of the agreement is staggering. Under Lip-Bu Tan's highly pragmatic leadership, Intel swallowed its historical pride and leaned heavily into strategic partnerships, doing the previously unthinkable by actively collaborating with Nvidia. Intel secured the highly lucrative contract to design and manufacture custom x86 CPUs exclusively tailored for integration into Nvidia's massive AI infrastructure platforms. Intel publicly acknowledged reality. To survive the ongoing artificial intelligence war, they had to play nice with the company supplying the weapons. These custom-fabricated processors will serve as the physical backbone for OpenAI's highly anticipated next-generation compute infrastructure. The partnership explicitly aims to deploy an astonishing 10 gigawatts of power capacity globally, utilizing the newly announced NVIDIA Vera Rubin platform, scheduled to begin rolling out to hyperscale data centers in late 2026. To give you an idea of what 10 gigawatts means, that is enough electricity to power the entire city of New York. And they are using it strictly to train AI models. The custom Vera CPU architecture, manufactured entirely in Intel foundries, is an engineering marvel designed to feed data to GPUs as fast as physics will allow. By connecting these custom Intel chips seamlessly to NVIDIA GPUs, the alliance aims to reduce the computing cost of massive large language models by up to 10 times. To physically back this technological synergy with hard capital and align corporate interests, NVIDIA took a massive leap of faith. They invested $5 billion directly into Intel stock, purchasing the equity at a price of $23.28 per share. Intel, in the year 2026, serves as an absolute masterclass in corporate survival and strategic restructuring. Think about what they accomplished. In just over 12 months, they completely replaced their executive leadership, purged layers of suffocating middle management, successfully shipped a generational leap in microscopic silicon manufacturing with the 18A node, and spent billions to buy back their most critical European factory to permanently restore profit margins.